So now looking at the costs of production, this is a really, really important section because it's actually setting up all of the information that you need to know for a really important section in the second year of the course, which is called the theory of the firm. But the good news is that all of this stuff in the first year is actually really, really easy to understand, but it's very, very important. So I would advise you to make sure that you know these concepts back to front. So, first of all, just a bit of a recap on the factors of production. You should know by now these are the resources needed to create goods and services and land, labour, capital, enterprise. That should be very easy for you to remember. Okay, so it's important because when we're looking at the difference between the short run and the long run, in economics, we've actually got a definition for the difference between the short run and the long run. So the short run is the period of time when at least one of those factors of production is in fixed quantity. So, for example, we'd usually say it's like the kind of capital, the building space that you have. So you can't just expand your building if you've got an increase in demand very easily. So that would be something that's in fixed quantity, whereas something like labour is usually a lot more flexible and you can take on temporary workers quite quickly. Now, because one of these factors of production is going to be in fixed quantity, your scale of production is going to remain fixed. All that means is that there's going to be a maximum output that you can produce. So think about that production possibility frontier with the actual curve, the frontier, that represents the maximum that you can produce in the short run. Whereas in the long run, we know there's going to be improvements in technology, we know we can expand, and therefore that line should be able to kind of move outwards. And so the long run is the period of time when all factors of production can be varied in terms of the quantity they have. So you can change your scale of production. And then this links into macroeconomics as well, like short run growth being an increase in aggregate demand, whereas long run growth, for you to have sustainable long run economic growth, you need an increase in that long run AS curve. So the key terms, more key terms, fixed costs and variable costs. So there's actually a difference between the types of costs that we're looking at. Fixed costs are costs that do not vary with output. That is such a short definition, but so important. Please make sure that you learn that one. And an example would be rent. The person that's renting you your factory or your office space, they really don't care whether you sell 100 units or 1,000,000 units. They just want the value of their rent. So it's not going to make a difference to them how many sales that you make. Whereas variable costs are costs that vary with output. Sometimes in business studies we call these direct costs because they go into the direct manufacture of the product. So raw materials would be a variable cost. If you've got people, labour that's working on actually producing the items, actually making the items, that would be a variable cost. Whereas someone like an accountant would be more possibly of a fixed cost. They're going to, as long as it's within certain output units, they're going to charge a kind of like usually a flat fee every year to do the accounts. Whereas the more you produce on the production line, the more employees you're going to need, and therefore that would be a variable cost. So just I'm bringing up that example because just sometimes labour, it's a bit unclear. If you're paying someone by the hour, we usually say that that's a variable cost, but if you're paying them a flat salary, that'd be more of a fixed cost. So labour is one of those ones that could kind of sit in between the two definitions. But total cost, that's easy to work out because that's just your total fixed cost plus your total variable cost. And this is what it looked like on a graph. So it's very logical. We've got total fixed costs being a straight line, horizontal line, because it really doesn't depend on output. It doesn't vary with output. Whereas we've got variable costs increasing. And this is the more realistic picture. If you do business studies and you do things like break-even analysis, you might draw your total variable cost as a straight line. Actually, we tend to see that it curves upwards like that. The reason for this is diminishing marginal returns. This is a concept that you'll learn in the second year of the course. It's a nice concept. It's a little bit complicated to understand at first, though. So if you want to do further reading on that, you can, but it's not required for the year one part of the course. And total cost, just because you're adding both variable cost and fixed cost together, that's why it sits on top of that total fixed cost curve. So average fixed costs would just be your total fixed cost divided by output, average variable cost, total variable cost divided by output, and average total cost would just be total cost divided by output. So really, really simple. These are more definitions for the second year. It's more this one that you need to know, this average total cost for the specification. And this is, if we put it on a diagram, this is what it looked like. Average fixed costs would continue to fall because each time you're dividing the total fixed cost by a greater number of output, and that's why that falls. We see actually an uplift in average variable costs, and this is that concept, diminishing marginal returns, that I was telling you about. Again, it's a little bit complicated to go through, so I won't go through it, but just, remember in your mind that that's what causes the uplift. I'm just going to get my pen out now because this is the one, average cost, is really important, and you just need to know that it is a U shape. So at first it falls like that, and then it increases as you get past a certain point. And the lowest point actually on this average cost curve is the point of productive efficiency, because that's where you can produce at the lowest average costs. So just looking here at the numbers in a table to help you to understand this. So as we would expect, total fixed cost staying consistent because they don't vary with the output. Total variable costs increasing, we'd expect that if we make more, we would have increased direct costs. It doesn't always jump by the same amount each time, and again that's marginal returns, first increasing marginal returns, and then after a while it's diminishing marginal returns, and then actually decreasing marginal returns as well, but that's year 2, so you don't need to worry about that then. So total costs are just going to be total fixed costs, actually total variable costs going to appear now. There we go. And then total average cost, you're just going to take this number and you're going to divide it by that number there. I can't divide it by a 0, so I'm going to put a dash there, but you can see 200 divided by 1 is 200. 230 divided by 2 is 115, and that's maybe what one of the questions is going to be. It could be a good multiple choice question, because it says here you need to be able to calculate average and total cost from given data. I know in the specimen papers there have been some examples of that. It could also be a format question possibly that comes up in the year 1 paper. And then here it's a bit of a vague specification objective. You just need to appreciate that short run average cost curve is likely to be U-shaped, but this link with the law of diminishing returns, as I mentioned, is not expected. Until year 2, that is. I haven't covered this one because I'm going to cover it in the next presentation where we look at economies and diseconomies of scale.